start with gold, where the prices remain under pressure, are holding around that $1,570 per ounce mark after falling nearly 3% in the previous week, below 57 on your screens at this point. A firm US dollar and deflation worries triggered by a global economic slowdown are expected to keep a lid on the gains there. The physical dealers, who have seen limited buying interest in recent weeks, said a slowdown in the global economy could force the jewelers, investors and speculators to tighten their purses. The trades in the oil also remain volatile today. The Brent crude prices slipped below $90 per barrel mark after the European markets opened. It has rebounded since, but the pressure remains. And there you have it on your screens. Nearly 1% of a decline coming in for both the crude prices. The NYMEX is now below 79, while the Brent is just about holding $90 right now in the space. Time for strategies then, and joining in the studios is Milan Bavishi. He is Head Commodity Research in Venture Growth and Securities, and Vijay Bambani, of course, carries on. Vijay, let me start with you, and let's start with the crude prices first. And further declines coming in there, 80 and 90 respectively for both those crudes, really seems to be a very soft support to say.
I would say so, yes, Manisha. I think what you are looking at now is basically the 78 quarter, 78 and a half kind of a band on the WTI. And on the Brent, I think you're looking at 88 quarter as the next immediate support. I'm not saying that these supports will hold, but barring any kind of a hurricane development on the US coast, I don't think there's too much by way of support, because let's not forget, cyclically speaking, in a US presidential election year, crude does tend to be soft, and we are seeing inventories in the US, the non-strategic commercial inventories rise pretty steadily. So I would not really be surprised to see a level of even $76 on the WTI grade. I think at higher levels, crude does become a sell, especially on rallies. And anything like 46.25 to 46.50 on the MCX July futures, I think crude might get sold into. And the next stop I think it would stop at is something like 44.30 or 44.20.
Milan, let's get you in the conversation as well. While the storm Debbie in Gulf of Mexico did give some support to the crude prices there, but it really is the global risk aversion which continues to weigh.
See, for crude oil, international manufacturing data was weak. The outlook for growth from US and China is weak. The stimulus that is doled out by US is not sufficient. It is less than expected. This has taken a toll on crude oil prices. But technically, I see a bullish divergence on RSI in NYMEX crude oil prices. Now, this is a positive indication technically. We could see some bounce back in crude oil prices, and some buying interest could come at lower levels. So, crude oil can be bought on declines on MCX around 4,500 levels for the target of 4,560, and stop loss can be placed at 4,470 for the day.
How about the natural gas prices though, Vijay? Because we have seen continuous strength coming in for that one. Would you say it might still see further gains from here?
I've been advocating gains on natural gas all of last week, and I think the 155 level is a critical short-term resistance. Once you see a level of 155 and above on a closing basis, and you see open interest and volumes expanding on the way up in tandem with prices, I think a base would have been created at the 144 to 148 band, and any kind of a pullback should not violate that kind of a band, in which case the next inflection point would be 162 and then 166 levels. Relatively speaking, natural gas is looking a little more stronger than crude at this point in time, although I do agree that there is some positive divergence on the RSI on the crude chart, but the price is looking sluggish. In the case of natural gas, relatively speaking, the price is looking a little more active.
Right, so on a weekly basis, nearly 4.5% of gains still coming in for that commodity, even as the crude prices have declined by as much in the previous week. Milan, how about the precious metals? Because gold is something that had declined quite sharply in the previous week after the Fed disappointment. We've seen it trading very flat today. What's the direction it's taking from here?
See, last week we saw correction of around 3% in gold prices, and this was on back, as discussed, that there are worries of deflation rather than inflation. Inflation fears have taken gold prices higher over the last few years, and now the worries have started for deflation. So, and this is negative for gold. Why? Because gold is always perceived as a hedge against inflation. Now the correction of last week could give some room for buying interest in gold, Why? Because gold has come near its long-term support levels. And on the daily charts, on the Friday, gold had given a bullish candlestick pattern called hammer, which is a bullish reversal pattern. So for the day, gold can be bought on declines around 29,800 levels. Target can be 30,000 and stop loss can be placed at 29,700 for the August series.
Would you say the same about silver as well, Milan? Because that also has seen a bit of a support coming in today. But is it good enough to start buying?
Yeah, that's right. See, for silver on technical momentum indicators called RSI, silver is showing a bullish divergence, and this suggests that prices could go up. So for silver, it's a buy at current market price for the targets of 53,200 and stop loss can be placed at 52,300 for the day.
Vijay, what's your sense in the precious metal space? Because after those sharp declines in the previous week, most of the positions had gotten cut. Are you looking at a bear market on the charts? Because the kind of sharp decline that this year gold and silver have seen, how is it looking to you now?
I wouldn't go out so far as to call it a bear market, because this is a US presidential election year and typically commodity prices do tend to soften. The level that I talked about on gold all of last week was 29,700. I might just give it a leeway of another 300 rupees and say 29,400 would be a level to watch out for in the coming week. Unless 29,400 is violated, I don't think even the momentum in the short to medium term is violated. So bear market is still far away. As far as silver is concerned, relatively speaking, it's looking a little more sluggish as compared to gold. And it would basically need to trade above the 54,800 levels to bring the bulls back into the ring and trigger even a mild kind of a bear squeeze. On the overseas commodity exchanges, anything below $26.40 I think would throw the ropes and the bulls to the ropes, and they would be on a clear defensive from which they would find a little bit of a spot to kind of emerge unless the prices really bounce back fairly rapidly. So I would not want to buy in the leverage segment, although delivery investments or SIPs can continue without any doubt.
Vijay, what's your sense in the base metal prices? Because there has been a bit of a rebound, but the kind of data that we have seen in all of the last week isn't really supportive.
I agree with you, Manisha. Up to last week, it was appearing that they were consolidating because there was neither a breakout nor a breakdown on the charts. But aluminium is leading the way down, and I think it's likely to weaken even further. And taking with it will be other non-ferrous commodities like lead and zinc. So keeping with aluminium, I think the June futures can be shorted at 104.5. A stop loss be maintained at 105.25. And a target of an even 103.75 be expected where profit taking can be initiated in the absolute near term. I would want to wait for some more declines before shorting lead and zinc, so maybe we'll take it up in the future, near future.
0.5% to more than 1% of a decline coming in for most of base metals. Remember, it's the rupee as well which has given up much of the gains today. Milan, how do you see the space?
See, for copper, if you observe what has happened is in last week, even copper saw some correction. That is primarily because of fundamental data that has come out from US and China, which are weak. So manufacturing activity, if it is weak, it is a bearish tone for copper as such. However, technically, copper prices have come near 200-day long-term moving average support. And on Friday, again, copper too gave a bullish candlestick pattern called hammer. So for the day, I would prefer buying copper for the targets of 417 and 420. Stop loss can be placed at 412 levels.
All right, so that's the view coming in from our experts there. That's how you can play the commodities in the very near term. Remember, there are much concerns coming in from the global market, so cautious also is the word out on the street. Milan, thank you so much for joining us with your sense on all of those commodities.